Preparing for a commercial banking relationship manager interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a commercial banking relationship manager do? A commercial banking relationship manager is the client-facing owner of a business banking relationship. I would describe the role as balancing growth, risk, and service. On one side, I originate loans, deposits, treasury services, and referrals. On the other, I understand the client's business, monitor credit quality, coordinate underwriting, and protect the bank. The best RMs are trusted advisors who create value for clients while earning appropriate risk-adjusted returns for the bank. While answering, focus on the RM's ownership of client relationships, revenue generation, credit discipline, portfolio management, and coordination with underwriting, treasury, product partners, risk, and operations teams. Question 2. Walk me through how you would assess whether to lend to a new commercial borrower. When I evaluate a new borrower, I start with repayment capacity, not collateral. I review historical financials, interim results, projections, leverage, liquidity, and cash conversion. Then I assess industry risk, management quality, customer concentration, collateral support, and the purpose of the borrowing. I also ask whether the structure matches the need. A seasonal revolver, for example, should revolve, not become permanent debt. My recommendation would combine credit judgment with relationship potential. Make sure to cover repayment capacity, purpose of borrowing, financial statement trends, industry risk, management quality, collateral, structure, and whether the opportunity fits the bank's credit appetite and relationship strategy. Question 3. Which financial metrics matter most when analyzing a commercial borrower? For a commercial borrower, I focus on cash flow durability. EBITDA margin, leverage, fixed charge coverage, DSCR, current ratio, quick ratio, and working capital trends tell me whether operations can support debt. I also look at revenue concentration, gross margin movement, inventory turnover, and receivable aging. 1 weak ratio is not automatically fatal, but a pattern matters. The strongest analysis explains the story behind the numbers and whether performance is improving or deteriorating. In your answer, talk about profitability, liquidity, leverage, debt service coverage, working capital efficiency, margin trends, customer concentration, and why ratios must be interpreted alongside business context and industry norms. Question 4. How would you build and manage a pipeline of new commercial banking clients? I would build pipeline through a mix of targeted calling, referrals, centers of influence, and existing portfolio expansion. The key is not chasing every business. It is defining the bank's credit appetite by size, sector, geography, and profitability. I would research prospects before outreach, lead with an industry insight, and track next steps rigorously. A good pipeline has stages, probability-weighted revenue, and enough activity to offset normal credit declines and lost deals. Be sure to mention targeted prospecting, referrals, industry specialization, centers of influence, disciplined follow-up, CRM tracking, qualification against credit appetite, and balancing new client acquisition with existing portfolio growth. Question 5. What would you do if an existing borrower started showing signs of credit deterioration? Early action matters because credit problems rarely improve by ignoring them. If I saw deteriorating performance, I would first verify facts through updated financials, borrowing base reports, conversations with management, and account behavior. Then I would reassess risk rating, collateral, covenant compliance, and repayment sources. I would involve credit partners early, document the plan, and communicate clearly with the client. The goal is to protect the bank while giving a viable borrower room to stabilize. While answering, focus on early identification, updated financials, client communication, risk rating changes, covenant review, collateral monitoring, escalation to credit partners, documentation, and protecting the bank without overreacting. Question 6. Explain how a revolving line of credit works for a business client. A revolving line of credit funds short-term operating assets, usually receivables and inventory. I would explain that it should expand and contract with the cash conversion cycle. If a distributor builds inventory before peak season and collects receivables 60 days later, the revolver bridges that timing gap. The bank monitors usage through availability, cleanup periods, borrowing bases, and covenant checks. It is not meant to finance losses, acquisitions, or long-term fixed assets. Make sure to cover short-term working capital needs, receivables and inventory financing, borrowing base concepts, seasonal usage, cleanup expectations, monitoring, and why revolvers should not fund permanent losses. Question 7. How do you think about pricing a commercial loan? Loan pricing should reflect risk, relationship value, and capital usage. I would consider the borrower's credit profile, tenor, collateral, structure, expected utilization, fees, deposits, treasury revenue, and competitive alternatives. A strong borrower with operating deposits may justify tighter pricing because total relationship return is attractive. A higher risk or capital-intensive deal needs stronger spread, fees, or structure. The RM's job is not just winning the loan, it is earning acceptable risk-adjusted return. In your answer, talk about credit risk, collateral, tenor, structure, expected utilization, capital allocation, fee income, deposits, treasury revenue, competition, and total relationship profitability rather than spread alone. Question 8. What is DSCR, and why is it important in commercial banking? DSCR measures whether cash flow can cover required debt payments. In simple terms, it is cash available for debt service divided by scheduled principal and interest. If a company generates $1.5 million of cash flow and owes $1.0 million in debt service, DSCR is 1.5 times. That cushion matters because revenue can soften or costs can rise. Banks use DSCR to size debt, set covenants, and evaluate repayment capacity. Be sure to mention the formula: cash flow available for debt service, principal and interest obligations, minimum coverage cushions, loan sizing, covenant setting, and the link to repayment capacity. Question 9. How do loan covenants protect the bank? And how would you handle a covenant breach? Covenants are early warning and behavior guiding tools, not just legal language. A financial covenant like maximum leverage or minimum fixed charge coverage lets the bank monitor whether the borrower stays within an agreed risk profile. Affirmative covenants require actions, such as providing financial statements. Negative covenants restrict actions, such as taking on additional debt. If a covenant is breached, I would assess materiality, cause, remedy, and whether a waiver or amendment is appropriate. While answering, focus on financial and non-financial covenants, early warning signals, borrower behavior, breach analysis, materiality, root cause, waiver versus amendment, risk rating implications, and documentation. Question 10. How would you prepare for an important client meeting? Before a client meeting, I would prepare around 3 questions. What does the client need? Where can the bank add value? And what risks should I understand? I would review financial trends, debt facilities, account activity, industry news, ownership changes, and prior call notes. Then I would set an agenda that combines relationship topics with credit monitoring. A strong meeting should uncover opportunities, validate risk assumptions, and end with specific next steps. Make sure to cover reviewing financial trends, current facilities, account activity, prior notes, industry developments, client objectives, potential risks, product opportunities, agenda setting, and clear follow-up actions. Question 11. Give an example of how you would cross-sell bank products without damaging the relationship. Cross-selling works when it solves a business problem, not when it feels like product pushing. If a client has excess operating cash, I might discuss liquidity solutions. If they receive many customer payments, treasury management may reduce float and fraud risk. If the owner is considering succession, I would involve wealth or investment banking partners. I would connect products to the client's goals, quantify value where possible, and coordinate follow-through internally. In your answer, talk about needs-based selling, listening first. Treasury management, deposits, merchant services, wealth referrals, foreign exchange, fraud prevention, quantifying value, and avoiding product-pushing behavior. Question 12. How do you manage a commercial loan portfolio with competing deadlines? I would manage the portfolio with a risk-based discipline. Credits with upcoming renewals, covenant pressure, Large exposures or weak trends get priority. I would maintain a calendar for financial statement collection, annual reviews, maturities, site visits, and loan exceptions. At the same time, I would protect time for business development. The best RMs do not let urgent administrative work crowd out revenue generation, but they also never surprise credit or risk partners. Be sure to mention prioritization by risk and materiality, annual reviews, renewals, maturities, covenant checks, financial statement tracking, exception clearing, client responsiveness, and maintaining business development momentum. Question 13. A client asks for a larger line of credit, but sales are declining. How would you respond? I would not approve an increase just because the client asks. I would first understand why sales declined and why more liquidity is needed. If the request funds a temporary working capital need with solid receivables and a credible recovery plan, an increase might make sense with tighter monitoring. If it funds operating losses, I would consider alternatives or decline. The structure should match repayment capacity, collateral, and the updated risk profile. While answering, focus on diagnosing the reason for the decline, cash flow need, borrowing purpose, receivable quality, collateral availability, projections, repayment source, risk rating, structure, and candid client communication. Question 14. What is the difference between collateral-based lending and cash flow lending? Collateral-based lending starts with asset coverage. Cash flow lending starts with repayment capacity from operations. In an asset-based structure, availability may be tied to eligible receivables and inventory with frequent reporting. In cash flow lending, the bank relies more on EBITDA, leverage, covenants, and enterprise value. Collateral still matters in both cases, but it is not the primary repayment source. I would match the structure to the borrower's stability, asset quality, and information transparency. Make sure to cover primary repayment source, asset coverage, borrowing bases, receivables and inventory, EBITDA, leverage, enterprise value, reporting requirements, borrower stability, and why collateral is a secondary source of repayment. Question 15. Why do you want to be a commercial banking relationship manager? I am interested in commercial banking because it combines finance, risk judgment, and relationship building in a very practical way. You learn how real businesses operate, from cash flow cycles to growth decisions, and you become a long-term advisor rather than a one-time transaction contact. A successful RM is curious, commercially minded, organized, and credible with both clients and credit partners. The role rewards people who can grow revenue without compromising risk discipline. In your answer, talk about interest in businesses, financial analysis, relationship building, credit judgment, long-term client advisory, revenue ownership, teamwork with product partners, and balancing growth with risk discipline. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.